So far, we've learned about buying options. So if you buy a call option, you are bullish on the market. And if market rise, you hopefully make a profit. If you're bearish, you buy a put option. And if the markets fall, you make a profit there. But if you're buying an option, be it a call or a put, someone somewhere is selling you that option to you. Think about it. So what do you think is option selling? Think of it as two people shaking hands over a contract. So Mr. Oberoi has bought out of the money call options and paid 8,000 for the premium. Ms. Chanda has sold that option contract to him and pocketed that 8,000 rupees. Now, three things that can happen. Prices can go up, stay the same, or fall. So let's say this trade was on Reliance. If prices of Reliance rise, then Mr. Oberoi makes a profit. And since he owned the call option, he can pocket that if he wishes. Ms. Chanda has to bear the brunt of this trade and pay the difference to Mr. Oberoi. If prices stay flat, then Mr. Oberoi loses small amounts every day because options have time decay and options fall every day till expiry. Chanda sees this as a profit because she gets to keep that 8,000 rupees if the option expires worthless on expiry day. Remember, she can also square this off on the side if she wishes and take a smaller profit. The third option, if prices fall, then Mr. Oberoi loses since he was invested to see prices rise. Chanda sees that as a profit. So now that you know what option selling is, let's see this with a real example. It's always good to see a real example so you can understand the nitty-gritties. Remember, if you're selling a call, you're actually bearish. And if you're selling a put, you're actually bullish. So it becomes a little of the opposite. And you want the value of the premium to keep falling, either because of time or because you're in the right direction. Now, the biggest advantage, as I've said before, of selling an option is the fact that you're gaining money because of time decay. As we're coming closer to expiration, the value of the premium keeps falling, assuming that the underlying is not moving. So that's a good advantage, right? Let's see an example of Infosys and how a possible trade could have happened. This is using real data, of course. So Infosys gapped up on 15th April 2014. Now, during this time, Infosys 24th April 3,250 call option was trading at rupees 55 and it has a lot size, the minimum number of shares of 125. This means with an investment of 6,875, you could buy these calls. Now, if you're buying these calls, you're profiting from a rise. So let's say you think that Infosys will fall. Let's see what happens the next day. Infosys falls 3.1%. Look what happened to the option prices. Now the next day, 16th April, Infosys actually fell 3.1%. Let me show you this chart that I can see right here. The option prices, because of this fall, went from 55 and now they're currently trading at 11.60. Now the difference between these premiums is a profit. So you sold at 55 and it's currently trading at 11.60. The difference of this is your profit times the lot size. Now you can do two things. You can either exit here, means buy the contract back and you pocket your profit, or you can continue to hold on. Now there's something interesting that happens. We'll teach you this later, but after a big fall, usually we see some sideways. Now if we do move sideways, we have the advantage of time because we're selling an option and time decay sets in. Let's have a look at this. Here's the chart again. The next 5 days unfold and the markets rise a little, fall a little, but largely stay flat. But look what happened to the option price. It went from 11.6 where it was originally, and now it's trading at 10 paisa right on expiry day. You can now close your position, and I think almost the entire 55 rupees was something that you pocketed in your pocket multiplied by the lot size. Isn't that amazing? That's the thing of writing options. I'm sure writing options is pretty clear right now.